Hello and welcome, and you're tuned into CNBC-TV18 Prime. Let's get cracking on a brand new edition of The Big C. I'm Manisha Gupta, and with me is Nigel D'Souza, your daily dose of commodities, cryptos and currencies. But Nigel, what are we focusing on today?
Well, Manisha, today we'll be focusing on the entire ferrous industry, particularly the domestic ferrous industry. This, as India's steel industry is, on course to outpace what the globe is doing. Now, steelmakers in India, the question is, can they notch up robust growth? Remember, the globe is an uncertain place to live in, but you have stable steel prices as well as demand that is expected to outstrip the globe. In addition to that, coking coal costs as well have been well behaved, and we have the benefit of safeguard duties as well. So the big question is, are steel companies bracing for improved margins? We'll take the discussion forward with Mr. Banerjee, who is in fact an industry expert. Well, before that, a quick roundup of the action unfolding in the global equity markets. Wall Street ended in the red amidst the mounting conflict between Israel as well as Iran. The Dow Jones Industrial Average, that was down close to around 300 points. A sense of caution prevailed as the street is now hawk-eyed on the Federal Reserve outcome that's scheduled for later tonight, amid the expectations of a status quo on the rates front this time around. But the commentary, as always, will be tracked.
Oh, absolutely. And meanwhile, the stock futures are absolutely flat. Apart from that, the key central bank outcome, we will also be watching out for the weekly jobless claims print that's later today. And then the markets also are looking at focus on the Fed outcome. CNBC's Steve Lehman brings us the highlights of the Fed survey and the key expectations therein. Let's listen in.
Despite improvement in the economic outlook, respondents to the Fed survey continue to forecast weaker growth and higher inflation than they did at the beginning of the year, and still elevated tariff uncertainty. 100% say the Fed will keep rates unchanged at this meeting. The recession probability, though, did drop by 3 points to 38%. It had been as high as 53%, but now it's down quite a bit, but still elevated. 3.9%, that's the year-end Fed funds rate, so still banking on 2 rate cuts this year. But they've kind of X'd out one for next year. At 3.55, only 1 rate cut built in, and the Fed will remain above that long-run neutral rate of 3.3%, which is the estimate of respondents here. GDP, 1.13%, that's up. That's a good thing from 0.8, but it compares with the forecast we had from January, which was 2.4%. 2026, we get back to at or above trend at 2.2%. That's 20 basis points higher than the May forecast. Doug Gordon, senior portfolio manager with Russell Investments, writes in saying, quote, recent geopolitical events in the Middle East add uncertainty into an already uncertain environment on trade, tax policy, and with potentially weakening hard macroeconomic data pending. 2025 forecast for inflation down a bit, down a quarter point, but still elevated at 3%. 2026 is when you get back to around where the Fed would be comfortable on the CPI at 260 in May. The unemployment rate also down a bit, 4.53, 4.5%, call it. That's down a couple tenths from where it was in the prior forecast. And unemployment in 2026, 4.47%. Mark Vittner, he's upbeat. He's the chief economist at Piedmont Crescent Capital. He says the economy has remained resilient, not terrified. There's no shortage of reasons to worry, but the U.S. economy keeps proving its doubters wrong. On a separate note, more volatility could be ahead, with most expecting an early announcement of Fed Chair Powell's replacement from President Trump. 64% say yes, a replacement for Powell will be named before the end of the year. 21% say no, and 14% don't know. Underlying many of these forecasts is the expectation that tariff impacts have yet to really hit the economy, along with disagreement over how much impact the big tax bill in Congress will have on growth. Both major swing factors in the growth, employment, and inflation outlooks for the year, of course, along with what the Fed ends up doing.
Well, and shifting focus to stocks in Asia-Pacific, sentiment is mixed across markets. The Nikkei, however, it managed to close with gains of nearly around 1%. Meanwhile, the Shanghai has notched up an absolute close, for the session. Back home on the Wall Street, tempered moves on Nifty, hovering around the day's low, consistently trading, below the 25,000 odd mark. The Nifty continues to trade in that band of around 24,450 to 25,000.
Well, while that's about the equities, but the crude oil price is also on the back of oil, and conflict between Israel and Iran has entered its sixth day. Overnight, the Brent crude prices spiked over 4%. This is as the U.S. President Donald Trump issues a full-fledged threat to Iran, demanding an unconditional surrender. In fact, in a post on Truth Social, Trump called the supreme leader of Iran an easy target, warning that the U.S. patience is wearing thin. And of course, a rub-off impact of this escalation was seen on the oil prices. Remember, crude is now up 10% just this week, and it is up by 20% in the last 1 month itself. But what's capping the gains? Well, some key triggers here. Israel, for the longest, has avoided Iran's oil export infrastructure. Is the reason you're not looking at the crude oil prices going up beyond and way above that $80 mark. In addition to this, output from OPEC and allies is also on a rise. And then the production from United States is peaking. It actually has near record highs. That is what is keeping the crude prices in check.
Well, meanwhile, the International Energy Agency has projected global oil supply to rise by 1.8 million barrels per day to 104.9 million barrels per day this year. Next year, the IEA expects an additional spike of around 1.1 million barrels a day. Now, according to the IEA, global demand is all set to peak at around 105.6 million barrels per day by 2029, while production capacity is poised to rise by around 5 million barrels a day to around 114.7 million barrels a day by 2030. Among other key announcements, IEA now expects oil consumption in China to peak in 2027, largely due to the rise in EV sales and higher natural gas demand.
Well, absolutely. Isn't that very interesting, Nigel? Because the world oil demand will peak in 2029, but the Chinese oil demand will peak in 2027, way ahead.
Yeah,
and we're looking at much, much higher supplies till then. Well, that's about crude oil, but let's also shift focus to the money market. And the greenback is steady at 98 kind of levels in the Asian and European markets right now, maintaining its recent gains as investors keenly await for the Federal Reserve's monetary policy decision. The dollar, of course, is digesting a mixed macro print. Retail sales in the U.S. came in softer than expected in the month of May, but consumer sentiment was solid. Here on, it will be a mix of geopolitics and macros paving the way for the currency markets going forward.
Well, on that note, let's hear out a word coming in from Marco Papik. He's the chief strategist at BCA Research on where he sees crude oil prices moving, as well as his view on the dollar index.
In the near term, I can definitely see oil prices going to 85, maybe even 90. But here's the fact. It doesn't really matter what Israel does. It doesn't matter what the US does. For investors, the only country that we should be focused on is Iran. Because it's very simple. Iran is either going to try to take oil barrels off the global market by interjecting the flow of oil through the Straits of Hormuz. It's either going to try to intervene in the shipment and the production of energy, or it's not. And if it does start to impact the flow of oil out of the Straits of Hormuz and out of the Middle East to the rest of the world, it's going to invite a pretty significant retaliation by the US against it. This is not a reason to be bearish equities. Now, I hear some clients say, yes, but this could significantly impact inflation and therefore central bank monetary policy calculus. And I just think to myself, what central bank governor or president is going to hike interest rates because of a conflict in the Middle East that is temporary in nature? I expect another 20% decline in the US dollar against major currencies over the next 3 years. And so we're at the beginning innings of that move.
Well, all right, a big decline in the dollar index coming in, as said by Mark, but a big win for the cryptocurrencies is what we also are looking at. In what is being called a watershed movement, the U.S. Senate has now passed the landmark Genius Act that for the first time establishes regulatory framework for the U.S. dollar-pegged stablecoin. The bill still had hurdles in the Republican-held House, but passage in the Senate signals a turning point, not just for the technology, but for the political clout behind it. Remember, the legislation grants sweeping authority to Treasury Secretary Scott Bessent, who last week told the Senate at Appropriations Subcontinent in a hearing that the U.S. stablecoin market could grow nearly 8-fold to over $2 trillion in the next few years.
Well, time for to slip into a short break, but on the other side, as promised, we'll have an extensive chat on how the Indian steel industry is shaping up. Mr. Banerjee is waiting for us on the other side.
Welcome back, and we'll talk all things steel now, and of course the importance of the raw material and the way India has seen higher production and ever-growing consumption as well. But before we get to our guest and extend this discussion, let's hear out excerpts of our chat with Steel Secretary Sandeep Pondrik on where he sees the sector headed.
There are like 2-3 kind of imports, as I said earlier. One is where the particular steel is not available intercountry, some specialty steels grades. So that's all right because those are not available. Second is based on lower price or dumping. That what the government has tried to discourage by imposing safeguard duty. I think that we have controlled to a large extent now. Based on the 2 months data of April and May, the total steel imports are much lower as compared to what they were in the last year. And if this trajectory continues, I think the steel imports will be about 50% lower than last year. We are the only major economy who is clocking double-digit growth, and as you know that last 3 years we have been clocking about 12% growth. So that's nowhere else in the world when the world steel growth is much lower, about 0.5%, 1%. So India is a bright spot in the steel consumption scenario. If you see in this particular year, 24-25, we increased by 7 kgs. We were 97, we approached about 104. My opinion is that in 2030 or so that's about 6 years from now, 5-6 years from now, we should be somewhere around 155, 160. And by 2035, we should be around world average of about 200 plus.
Well, to take that conversation forward, we're joined by Mr. Sushim Banerjee, the CEO of Indian Iron and Steel Sector Skill Council and former DG, Institute for Steel Development and Growth. Hi, Mr. Banerjee. Thanks a lot for joining in here on the show. Well, sir, you know, India has been a bit of an outlier. Even if I look at the past year, the global demand basically didn't grow that much. But India's growth out here has been in double digits. Do you think India can continue to remain the bright spot, though the global cues are fairly jittery as we speak?
Okay, I think this is a very commonly asked question, that whether India will be able to maintain its growth trajectory despite the global slump, I would say, in some of the major advanced countries, major steel producers like Korea, Japan. They have all been showing negative growth. But despite India, despite this global somewhat subdued scenario, and which is likely to be more in view of the geopolitical scenario that we are now seeing, I would say that Indian steel industry's growth will basically be dependent on the government expenditure on the infrastructure sector. Unfortunately, for the last year, what we find that there was a drop in the capex by the government to about 7.1% against 8.8% what we observed in 23-24. But thanks to the very timely measures that the government has taken, first of all, the government is once again spending on infra. Most of the railway projects are now mostly been announced on schedule. However, there was last year there was also a scenario of decelerating consumption, the private consumption expenditure was going down, and that was a very worrying scenario. And thanks to, once again, the government timely step in the budget, we have seen that the middle income group, there it has received a standard boost, which will lead to more expenditure by the middle income group, which is the basic stronghold of private final consumption expenditure. And along with that, the Reserve Bank of India has also reduced the reserve ratio. As a result, the banks are now being given more than 2 lakh crores, which they can give it for further credit. So that way, liquidity scenario in the market is going to improve, and these two factors taken together, the increased government expenditure on infra and the increased expenditure, consumption expenditure by household sector particularly, will lead to somewhat better scenario, a good scenario for steel consumption. However, there are one or two factors that will determine, as we just heard Secretary Steele, that India, like any other country, is too much concerned that our exports are really going down and imports were going up. Due to this timely intervention by the Ministry of Commerce in imposing safeguard duty of 12%, that has halted the flow of import for the time being. But it is only for 200 days. That means by middle of July or middle of September, this will have to be reviewed, and depending on the scenario that time. But I would say that so far as the current scenario is, the our internal demand scenario, there is some hiccup in some of the major consumption area like real estate, as well as in the infra, where we would like that the private corporate sector also must come in a big way. So far as the steel plants are concerned, a lot of major expansion projects have been announced, which will give fillip to the steel demand. So I
Fair
would
point.
say that
Mr.
yeah.
Banerjee, since you are already talking numbers, I just wanted to interject a question with numbers itself. So while we are looking at ambition of 300 million tons by 2030 and of 500 million tons by 2047, would you say that the financial commitments, CAPEX, is in line to achieve those? That's one part. And the second part is about the raw material security for steel. I mean, that is something that also is quite high in debate.
Yeah. Yeah, I'll take your first point first, that 300 million ton is the capacity. It is not the actual production. That was hinted in National Steel Policy of 2017. We are now currently operating at more than 200 million ton current capacity. So another 100 million ton capacity in the next 4 or 5 years at a rate of 10 to 12, 15 million ton per annum. I think that will not be a scenario which is far reaching. So 300 maybe in 1 or 2 years time, here and there, maybe 31, 32 or late 31, we should be able to reach 300 million ton. But beyond that, there is a scenario like, you must be hearing quite a lot about the greening of steel, the decarbonization impact. And that will have to be taken up very seriously, because
Sure.
the green steel will definitely require a lot of huge investment. The prices also will go up. So, beyond 2030, one has to keep their finger crossed whether this, linear growth will be maintained or not.
Okay. My next part really was about the raw material security. And since you've spoken about green steel already, what is your sense on that then? How do those numbers look?
Yeah, green steel, so far as the large players are concerned, which they control about, more than 52, 53% of the total production. In fact, all of them are going ahead with this, greening of green technology in various stages, whether it is carbon capture and utilization, or whether it is capturing of the carbon at the blast furnace stage. And also, the DRI-EAF route. That is the current scenario that, if you can use green hydrogen instead of natural gas and use the renewable energy, then that is the surest way of you know bringing down the carbon emission. So these are various experimental stage. All steel industry is going ahead with that. So far as the raw material scenario is concerned, this is a very right question you have asked, because what we are seeing that cooking coal, as you know, we are highly dependent on imports. Although the prices are more or less very manageable at the current time, 193 or $200, it shot up to 360, 350 only a year and a half back. So I think this scenario, cooking coal scenario, is a little bit concerned or little bit uncertain. So far as the iron ore is concerned, as you know, India is abundant reserve, but I think we'll need to focus on high quality iron ore, and that is why the beneficiation technique has to be much more widespread, so that the internal generation of our iron ore gets good quality, and our raw material scenario is also taken care of.
Interesting point you make, Mr. Banerjee, because for India market perspective, the producers, when iron ore prices move up, actually it's a net benefit for the steel producers out here, because we have iron ore out here. However, when coking coal costs move up, it's all imported. So that's when we get hit. So that interesting point out there. Couple of questions now, since we were focusing on green steel. What is the capex difference if someone is setting up a normal steel unit, carbon steel, and if you're setting up a green steel focus plant? Is there a difference in the capex plan? Because normally we work for by 1 million tons of steel cost $1 billion, very approximately. So is there a big capex difference?
Yeah, I think the technology is somewhat different in the sense that in the blast furnace route, what we are trying to do, and all the large producers are trying to do, if they want to stick to blast furnace route, which they are going to have in the next few years' time at least, then the carbon has to be captured while it is being injected in the blast furnace. And so there are various technologies are there. The TWAR or the upper vessel, upgradation need to be there, for which you need some investment. But the on the other hand, the DRI-EAF route, which is a very carbon less carbon emitting route, that there also you need investment, but from the current capex level, I am sure there will be between 15 to 20% more investment that will be required to set up these units. Because blast furnace route, what what we are trying to see, there are a lot of pilot projects are going on under Ministry of New and Renewable Energy, for which government has come forward to give subsidizing these initial efforts. So if that bears fruit, I think that will be a golden thing for India to go ahead with the maybe 20-25% of green hydrogen, and balance from the other route of coal and other things. So there also it will be a significant impact on the carbon emission. As you know, Ministry of Steel has come out with the taxonomy of green steel, and that is a very good effort, I must say, so that the medium and small industries, if they can take advantage of that, then that will be a good thing, along with all the efforts of the large players.
Sure. Mr. Banerjee, we'll wind down this conversation with one final question, and this is about the international markets then, because there's just so much happening there. We've seen the Chinese steel prices fall to a 9-month low. The Chinese data hasn't been so strong as well. And then there are tariffs and geopolitics as well. What's your sense on what's happening in the global markets as far as steel is concerned?
Yeah, I see, what we are seeing, I'm talking from the Indian point of view. I think government is correctly doing that, the trade negotiations. That is I think that is in such a scenario of huge uncertainty, that is the only surest way of entering into the market in a stable manner. So the trade negotiation, either with US or with EU, or with, I will say, or with China, that will be the surest way of navigating properly in this current scenario. And so India is also going ahead with that. I think in some of the areas we'll have to reduce our tariff for other products, and some of the areas, we will get access free or the in the international market. The recent steps that as EU has announced is, I would say, not a very favorable one for India, because there is no specific quota has been announced, and India has also been put along with other pooled category in the other categories. So that is an issue that I think has to be taken care of properly when India negotiates with EU team. And steel is a very major factor of consideration so far as India is concerned. And I'm sure US and other major producers also will see
Yeah.
India's point of view in a square way.
Well, Mr. Banerjee, thanks a lot for joining in. To sum things up, India's on a good wicket, actually. The problem is what's going to go on with regard to China, because their exports continue to mount and remain at elevated levels. For the time being, though, we can pat our back on the fact that India's steel demand growth will outpace what the globe will see. Thanks a lot, sir, for joining in and giving us your view on how do you see the industry shape up. Well, on that note, though, we'll have to wrap up on this edition of The Big C. You stay tuned for more news and updates on the other side.